All right, everybody, let's go. We've got 20 awesome investment style real estate exam questions that should help you significantly when you come across questions like these on that exam. Without further ado, let's get into them. All right, question number 1. Which of the following is the tax provision that allows investors to defer capital gains taxes by reinvesting the proceeds from the sale of one investment property into another similar property? Letter A, REIT. Letter B, 1031 exchange. Letter C, MACRS. Letter D, the capital gains tax exemption rule. And the answer is letter B, 1031 exchange. All right, so there's a couple of things here that are very common, and all of these are something that you want to know a little bit about on an exam. So this is one of those questions where you're going to see a little bit of representation on, well, which one is this? And it's asking us, which is the tax provision? That's usually the telltale sign. Now, the number one wrong answer was the capital gains tax exemption rule. And the capital gains tax exemption applies to owner-occupied property. And you will see that exemption rule on examinations, but that is not this, because the other telltale is allows investors to defer capital gains tax by reinvesting the proceeds from the sale of one investment property to another. Now, REIT stands for Real Estate Investment Trusts, and this is not a tax provision. Real estate investment trusts are vehicles that people can buy fractional ownership interests in investments that hold real estate portfolios. They're awesome. You'll learn a little bit about them in these types of courses, but study them later and you'll love them. All right, and then we have MACRS, which stands for Modified Accelerated Cost Recovery System. And it's our tax form of depreciation that we prefer. There's another one called straight line depreciation, and these are types of depreciation events for taxation. But it's not a tax provision that allows investors to do this deferring of capital gains. So the 1031 exchange is the correct answer. This is an excellent question. This is something that you would want to know for examinations. Let's go on to the next one. Question number 2. What is the maximum capital gains exclusion available when selling a primary residence? Letter A, $500,000 for married couples, $250,000 for single homeowners. Letter B, $250,000 for married couples, $500,000 for single home owners. Letter C, $100,000 for married couples, $50,000 for single homeowners. Letter D, $300,000 for married couples, $150,000 for single home owners. And the answer is letter A, $500,000 for married couples and $250,000 for single home owners. So the capital gains tax exclusion is applied to primary residence for owner-occupied properties. And this exclusion, in so many words, really is just saying that if you were to sell your property and you realize a gain up to $500,000 if you are married, then you don't have to pay capital gains tax on that amount. Anything above that, then there will be a tax, but the capital gains exclusion is for primary residences. Now, the other numbers were just red herrings. This is a pretty straightforward question, a good question, and you definitely want to know the intelligence of this question. You want to know the fact of $500,000 and $250,000. Now, this number can change over time. It has changed over time, so you definitely want to know that it can evolve, but currently, as you're watching this, that's what the exclusion is. Question number 3. What does the capitalization rate or cap rate indicate in real estate investing? Letter A, the total return on investment, including cash flow and appreciation. Letter B, the relationship between a property's net operating income and its market value. Letter C, the amount of property taxes owed based on the property's assessed value. Letter D, the percentage of a property's value that can be financed through a mortgage. And the answer is Letter B, the relationship between a property's net operating income and its market value. So capitalization rate is something that you want to know. Income analysis, and this is all in the valuation sections of your books. You're going to learn about the income analysis, the basic income analysis. You'll also learn about the gross income and gross rent multipliers, which are quicker ways to be able to get sort of an understanding of what something might be worth based off of what it generates. And you want to understand what a cap rate is. So this is pretty simple, straightforward, and knowing that it's the relationship between a property's net operating income and its market value, and that correlation between those three things, you will be able to solve for all of those different items and expect something like that on your real estate exam mathematically. In addition to having the knowledge of what these things are definitionally, you're also going to need to know how to calculate some of this stuff. Question number 4. What is the time frame for identifying and closing on a property in a 1031 exchange? Letter A, 30 days to identify, 90 days to close. Letter B, 90 days to identify, 180 days to close. Letter C, 60 days to identify, 120 days to close. Letter D, 45 days to identify, 180 days to close. And the answer? Letter D, 45 days to identify and 180 days to close. So the basics of a 1031 exchange should definitely be known for both salesperson and broker's examinations. Again, they're not going to go too in-depth with 1031 exchanges. And these are, again, investment questions that you see a few of on real estate exams. And the reason why we're going over these is because oftentimes I'll hear students just on the cusp of failing. And they're like, man, I failed just by like a point or two. And I'm like, oh, well, shoot, if you would have known a couple of other concepts, that would have just pushed you over the edge. So these are the push you over the edge style question topics in investments. You're not going to get a lot of these questions. You're going to get some. And these are pretty easy, but you want to know the basics. You definitely want to know some of the basic vocabulary of a 1031 exchange. Check our site. You'll find other references to 1031s. Absolutely. And you're going to be fine. Question number 5. What is a primary advantage of investing in a real estate investment trust, or REIT? Letter A, direct ownership of physical properties. Letter B, the ability to exchange an investment property for a non-like-kind asset. Letter C, liquidity and a diversified investment portfolio without direct involvement in property management. Letter D, guaranteed returns with little or no risk involved. And the answer? Letter C, liquidity and a diversified investment portfolio without direct involvement in property management. Another type of investment vehicle that we want to know a little bit about is what a REIT is. And a real estate investment trust is what it stands for, are types of investment vehicles that allow people to purchase into fractional ownership interests and buy a piece of a much larger real estate portfolio. So they're amazing and they're publicly traded. Learn about them. You won't get a lot of questions on real estate exams about them, but you will possibly be seeing the reference to a REIT. It could be a wrong answer on a question. It could be something like that, but you definitely want to know what it is. And this question is actually pretty good to sort of define it in terms of simplicity. Question number 6. What is the primary purpose of a 1031 exchange in real estate investing? Letter A, to avoid paying capital gains tax on the sale of an investment property. Letter B, to offset capital gains from the sale of a personal residence. Letter C, to maximize rental income from a property. Letter D, to defer capital gains taxes on the sale of an investment property. And the answer is letter D, to defer capital gains taxes on the sale of investment properties. All right, so the basic definition of a 1031 exchange is being displayed in this particular question. It's a really simple question, but it's a good one to study because you're going to be able to understand sort of what a 1031 exchange is fundamentally. And again, you don't need to know these huge levels of depth for these questions. You just want to know what they are and be able to move on to the next one. Question number 7. The increase in the value of a property over time, often due to factors like market trends, improvements, or demand in the area, is called Letter A, rate of return. Letter B, capitalization. Letter C, appreciation. Letter D, anticipation. And the answer is letter C, appreciation. Okay, this is straight, again, to the point. What is appreciation? Well, it is the increase in value of a property over time due to factors like market trends, improvements, or demand in the area. And that's basically a pretty decent definition for what appreciation is. Question number 8. What is the typical useful life for residential and commercial properties in terms of depreciation? Letter A, residential properties, 27.5 years, commercial properties, 39 years. Letter B, residential properties, 15 years, commercial properties, 30 years. Letter C, residential properties, 39 years, commercial properties, 27.5 years. Letter D, residential properties, 25 years, commercial properties, 50 years. And the answer is letter A, residential properties hold 27.5 years for depreciation and commercial properties are 39 years. So with the modified accelerated cost recovery system that we've adopted for depreciation, we've allocated this length of time for residential investment properties and for commercial properties. And we can depreciate these assets over those times at maximum. So again, you want to know the numbers, 27.5 for residential and 39 years for commercial. If you can just keep that in the back of your mind somewhere, then you should be good to go when you see a question like this referring to useful life in terms of depreciation. Question number 9. What is the primary purpose of the income capitalization approach in real estate valuation? Letter A, to determine the market value of a property based on recent sales of comparable properties. Letter B, to evaluate a property's worth based on its current occupancy rate. Letter C, to assess the value of a property by calculating its replacement cost. Letter D, to estimate a property's value based on its potential income generation. And the answer is letter D, to estimate a property's value based on its potential income generation. And that, again, is pretty textbook of what the income capitalization approach is as a definition. And you'll be knowing this plus how to do some of the mathematics, and you should be good to go on exam questions with income cap. High probability would be income capitalization questions on real estate exams. Question number 10. What is the relationship between cash flow and net operating income, or NOI, in real estate investing? Letter A. NOI factors in debt service while cash flow does not. Letter B. Cash flow is calculated by subtracting debt service from the NOI after operating expenses have already been accounted for. Letter C. NOI includes all expenses and debt service, while cash flow does not factor in income or expenses. Letter D. Cash flow is the same as NOI. Both represent total income from a property. And the answer? Letter B. Cash flow is calculated by subtracting debt service from the NOI after operating expenses have already been accounted for. And understanding the relationship between cash flow and operating income, NOI, the net operating income, and also kind of understanding what is an operation expense versus what is debt service in terms of expenses. And those are some of the fundamental nuances that you want to understand about the income a capitalization approach. It's going to help you. So you definitely want to know. There's a trick many times that you might see on exam questions where they'll give you the math and they'll throw in a mortgage payment and they're trying to see if you'll put that in as one of the expenses when you're trying to figure out capitalization. And you want to avoid that. You don't want to include the mortgage payment. Just like in this question, they're kind of referring to it as cash flow is calculated by subtracting out debt service later. Okay? So you want to go through all of your calculations, all of your operating costs, and then after that, you get to your net operating income. Then you can get to cash flow by subtracting out any debt service if they're asking you what is the cash flow. Question number 11. What does the rate of return, ROR, measure in an investment? Letter A, the total annual income generated by the investment property. Letter B, the net gain or loss of an investment expressed as a percentage of the initial investment. Letter C, the difference between the sales price of the relinquished property and the purchase price of the replacement property in a 1031 exchange. Letter D, the amount of debt associated with an investment. Answer? Letter B, the net gain or loss of an investment expressed as a percentage of the initial investment. ROR, rate of return, is something that you just want to know the basic calculation. We do it in our math book. You can find that in the link below. We cover a bunch of that. Those calculations, rate of return and a lot of other things like capitalization, et cetera. But, or look on our site and you might find a couple of references to it as well. Rate of return is a very simple one, low probability actually, probably wouldn't worry about it too much for the real estate examination, but I've seen lots of practice exams and I've seen that ROR comes up sometimes, so you might want to just brush up on how to calculate it and the basic definition of what it is. Question number 12. What does the vacancy rate measure in real estate investing? Letter A, the percentage of rental units that are unoccupied. Letter B, the total cost of maintaining vacant properties. Letter C, the average time it takes to fill a vacant unit in an investment property. Letter D, the time it takes to have delinquent tenants removed from a property. And the answer? Letter A, the percentage of rental units that are unoccupied. So vacancy rates are simply used during income capitalization mathematics questions. And you'll tend to see those there. They'll say factor in a percentage for vacancy. They might say 3% for vacancy loss, 4% for vacancy. Well, they're going to give you that number. And you just have to figure out what that number is and subtract it from the effective gross income or the actual gross income and get to the effective gross income, And then from there, you can start subtracting out the operation costs, and then you can get to your net operating income. So you'll learn how to do that as you're practicing in your various classes or in your books that you're using, but just learn how to do that flow and you should be good to go. Question number 13. The expectation that future events or changes, likely infrastructure developments or zoning changes, will positively impact a property's value is called letter A, appreciation. Letter B, capitalization. Letter C, anticipation. Letter D, market return. And the answer? Letter C, anticipation. All of these things are different vocab phrases that you tend to see. And again, they might present it like this. You might not need to know all of them, but you need to know what some of these are so you can exclude them as answer choices as you're reading through questions. So you want to know what the definition of appreciation is. You want to know what the definition of capitalization is. And anticipation, you will find definitions for anticipation in the appraisal sections of your studies. So it's one of those economic principles of valuation, and you'll find them there in those chapters. So look there, you'll find them among other vocab phrases, things like regression and progression and substitution, highest and best use, just to name a few, and you'll find them in there, but learn anticipation because it could come up as it did in this question. Question number 14. What does the cash-on-cash return measure in real estate investing? Letter A, the total profit made from an investment property. Letter B, the amount of income an investor makes from the property after deducting debt service. Letter C, the return on an investor's cash investment expressed as a percentage. Letter D, the total revenue generated by a property's rent payments. And the answer? Letter C, the return on an investor's cash investment expressed as a percentage. So like rate of return, ROR, You also want to know cash-on-cash return and how to calculate this basic number. You'll see a lot of this in the back in the math sections of your books potentially. So that might be where you find it, or the math calculation frameworks that they give you. Some books have them, some books don't. The formulas, etc. You might find this cash-on-cash return measure, and you'll see a practice question or two on it. Just check it out. Again, I think it's lower probability than things like capitalization, but you definitely want to brush up on it, and you want to know like rate of return, return on cash, and then like cash-on-cash returns. Question number 15. Which of the following equations is used to calculate the gross rent multiplier, or GRM? Letter A, purchase price divided by the net operating income, or NOI. Letter B, purchase price divided by the property's annual rental income. Letter C, annual income divided by the property's current market value. Letter D, annual property tax payments divided by monthly rental income. And the answer? Letter B, purchase price divided by the property's annual rental income. So you want to know how to calculate a few of these in addition to the income capitalization sort of method. And the other two that you typically see are the gross income multiplier and the gross rent multipliers. And these multipliers are just quicker ways to be able to get to a valuation understanding based off of what it generates in an income producing property, smaller income producing properties many times. The income capitalization approach is what we typically use for larger income analysis, larger buildings, larger projects. These GRMs and GIMs we typically use for smaller properties. But you want to know how to do them and check your books for some examples to get the math in addition to the definitions under your fingertips. Question number 16. What does the acronym PITI stand for in real estate finance? Letter A, property income taxes and interest. Letter B, principal, interest, taxes, and insurance. Letter C, payment, insurance, taxes, and interest. Letter D, price, investments, taxes, and insurance. And the answer is letter B, principal, interest, taxes, and insurance. I am fairly confident a super simple question like this is probably going to be on a real estate examination. They just want you to know what PITI stands for. It's the 4 parts to a mortgage payment: principal, interest, taxes, and insurance. There's several sort of initialisms and acronyms that you want to study for that. This is absolutely one of them. Question number 17. What does the debt service coverage ratio indicate in real estate investing? Letter A, the ratio of a property's debt to its equity. Letter B, the relationship between property value and loan amount. Letter C, the ability of a property to generate enough income to cover its debt obligations. Letter C, the cash flow remaining after debt payments have been made. And the answer? Letter C, the ability of a property to generate enough income to cover its debt obligation. So they call this the DSCR, stands for the debt service coverage ratio. And typically you'll see these applied to some income analysis questions. And basically what you want to remember is that at minimum debt service coverage ratios are like $1.20. So like for every dollar that you every $1.20 that you generate, what's acceptable at the very minimum is spending up to $1 on expenses. So DSCRs are sort of calculated like that. Underwriters look to them, lenders look to them to find out that the investor is somewhat profitable and not negative, obviously, but also profitable enough that it makes investment sense to buy an investment of this type. So you want to definitely know that debt service coverage ratio might be used, might not be used, but it's pretty important to know the definition, I would say. Question number 18. Which of the following most accurately describes a real estate syndication? Letter A, a method for financing real estate using a single investor's capital. Letter B, a strategy focused on acquiring multi-unit properties in high-demand residential areas. Letter C, a process where investors buy shares in a public company that owns real estate. Letter D, the pooling of money from multiple investors to collectively invest in a property or group of properties. And the answer? Letter D, the pooling of money from multiple investors to collectively invest in a property or a group of properties. So the definition of what syndication is there. We also talk about the definition of what a real estate investment trust is here, and they kind of reference that here in letter C, is a process by which investors buy shares in a public company that owns real estate. And that's a very fundamental definition or simple definition of what a REIT is compared to real estate syndication. So you want to know, again, the definition of what a syndication is. It's helpful. It could be that one question that gets you over the top, and you want to know that it's the pooling of money from multiple investors collectively to invest in properties or a big grouping of properties. Question number 19. What is the difference between gross income and net income in real estate? Letter A, gross income is the income remaining after expenses, while net income is the total income generated from the property. Letter B, gross income is the total income generated from the property, while net income is the amount remaining after operating expenses are deducted. Letter C, gross income includes only rental income, while net income includes both rental income and capital gains. Letter D, gross income and net income are the same thing. They both represent the property's total income after expenses. And the answer? Letter B, gross income is the total income generated from the property, while net income is the amount remaining after operating expenses are deducted. This is a very straightforward question, and knowing the definition of gross income and net income is pretty important. You will typically see this in the income capitalization approach, and it's effective when you understand what are operating expenses, what's effective gross income after vacancies, what's gross income, and what's net operating income after operating expenses are deducted, and the cash flow, or what's the cash-on-cash return, and the rate of return. All of these kind of all go together as you're figuring out investment analysis when it comes down to real estate decisions. Question number 20. Which of the following factors does not directly contribute to an investor's perceived value of a potential investment property? Letter A, zoning and land use. Letter B, anticipation. Letter C, economic obsolescence. Letter D, pilotage. And the answer? Letter D, pilotage. All right, so which of the following factors does not directly contribute to an investor's perceived value of a potential investment property? Well, zoning and land use does affect, obviously, what you can and cannot do with the property, and therefore it will directly contribute to an investor's perceived value of a potential investment. Anticipation is another economic principle of being able to look at the environment around the subject property and determine as the things are growing, regression, progression, those types of things. Those are all critical in understanding what anticipation is, also factoring in things like economic conditions and socioeconomic conditions as well. And then economic obsolescence are things that could affect the value of the property, and we have no control over those forces. So these external forces, these economic obsolescence items, are also directly items that contribute to the overall perceived value of an asset. But plottage is more of this sort of outlier. It's a little bit less. And again, plottage is a tough one. I would say that this question is a little slippery because plottage could be argued that it would be contributing to the perceived value of a potential investment property. But what they're really trying to hit here is these larger pictures, government controls like zoning and land use, anticipation, looking at the surrounding area, economic obsolescence, which are things that are outside of our control, all are going to directly contribute to an investor's perceived value of a potential investment property. All right, 20 investment style real estate questions, and hopefully these will help you get through that little section. Again, these questions aren't going to be this huge predominant representation on a real estate examination. They're going to be a few and far in between, but they do pepper them through, and they're relatively easy to get once you kind of go through them and understand them. Again, coupled with this would be some additional mathematics that you want to study. Remember, we got you covered if you need additional math help. We just came out with an amazing math book. Link is in the description below. We'll help you get some examples, video explainers, and everything else of me going through the mathematics of calculating all of these things that we just learned about and many more in the course. So, good luck with your studies. Thanks for subscribing and supporting the channel and everything. It's been tremendous. We've been growing and growing and growing, and we owe it all to you. Good luck with your studies. Good luck on your exams, and we'll see you in the next one.